Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing SolarEdge's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 2.8 billion market cap. They're trading at $49 a share, and they have 57 million shares outstanding. SolarEdge designs, develops, manufactures, and sells direct current optimized inverter systems for solar photovoltaic installations in the US, Europe, and other countries. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. With the lowest revenue, they had positive free cash flow. Then their revenue grew 58% and it was negative. That is common. When companies grow, they tend to invest more into CapEx to grow and scale their business. But at some point, you want to generate positive free cash flow because the investors want a return, either a dividend or stock buybacks. So you can see their free cash flow is getting worse each time period, up to negative 600 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive each year, but negative in the trailing 12 months. Revenue is the sales for the company, and that grew a lot from 21 to 22, down a little in 23, but down 25% in the trailing 12 months. Not a good trend. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 6 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $4.8 billion. We divide that by 57 million shares. And we get a calculated stock price of $83. They're trading at $49, so they're trading at a 41% discount. It's a strong buy according to the model. There are 26 companies in the same industry as solar, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 159 million. They have a good debt to equity ratio. For every dollar of equity, they have 30 cents of debt. Negative free cash flow like most companies in this industry. They rank 5th in market cap. Their price to book and price to sales are good, but we can't look at their PE or price to free cash flow because they have negative earnings and negative free cash flow. They do generate a lot of revenue relative to their market cap. They have a good price to sales. And their 5-year annual revenue growth rate is 17%, which is below the median average. If you put $10,000 into this company when they started trading in 2015, you'd be pissed off today because at one point it would have been $130,000, but then it would have came way down to $23,000. It's a really volatile market. It goes way up and comes way down. But at least you'd be in the green the entire time, except for one little blip right here. Let's take a look at their most recent 10Q. We'll start with their income statement. Their revenue came down a lot, from 940 million to 200 million. Let's get a breakdown of the revenue. Of the 200 million of revenue, 190 million is solar segment. That is down from 900 million. Energy storage segment is up a little, that's 10 million. All other segments, 3 million, down from 26 million. And they do financing, that's only a couple $100,000. Let's see their explanation for why their revenue went down 78%. It's from a decrease of 600 million related to a decrease in the number of inverters and power optimizers sold. So they sold less, which is obvious. A decrease of 78 million related to the lower number of batteries for PV applications sold, mainly in Europe. And a decrease of 23 million in revenue generated from e-mobility components. That's related to the discontinuation of the company's LCV e-mobility activity. A major decline in demand in the third quarter of 2023. This decline was a result of high inventory and slower than expected installation rates, which led to unexpected cancellations and push-outs of existing backlog. The expenses directly tied to generating the revenue is 231 million, so they have a gross loss. Last year they did have a gross profit, so they need to scale up more in order to cover their fixed expenses. And then they have operating expenses like R&D, marketing, general administrative. That just adds to their loss. They have an operating loss of 170 million. Last year they did have operating profit of 144 million. They did get a tax benefit this year. That was 24 million. So their net loss is 157 million. and they are adding shares. Last year, 56 million, now it's 57 million. Let's look at the balance sheet. This is their assets. Current assets, 3 billion, 660 million of current liabilities. So they have a pretty high current ratio. They have 700 million of cash and marketable securities. Their customers owe them 400 million, and they have a lot of inventory, 1.5 billion. Most of the inventory is ready to be sold, 1.2 billion. Only 300 million of raw materials. Hopefully they can sell the inventory and they don't have to scrap any. Total assets, 4.2 billion. After inventory, their biggest asset is PP&E, 600 million. They have 1.3 billion of liabilities, same as last year. They have a $600 million convertible note. This is debt that can be converted to equity if the stock price goes up. You don't see this too often. Warranty obligation, 320 million. They actually have about 500 million of warranty obligation, 320 million in non-current, 180 million in current. Assets minus liabilities equals equity, 2.2 billion of equity. They raised 1.7 billion from selling their business. They bought back 33 million of stock, and they profited 621 million from running their business. Let's look at a statement of cash flows. Their operating cash flow in the first quarter was negative 217 million. Last year, they squeaked out a small positive. The way to calculate the negative 217 million, start with the net loss of 157 million. Then we add back the non-cash items on the income statement. It looks like they had to pay back a lot of payables, 210 million. They did have a similar cash inflow in receivables, 210 million. A big cash outflow of inventory, 105 million. Last year was more, 141 million. In their investing section, they only spent 26 million of PP&E. Last year, 38 million. It looks like they acquired some private companies for 8.8 million. In their financing section, they bought back 33 million of stock. I wonder why they bought back stock with negative operating cash flow. They bought 500,000 shares at an average price of 66 bucks. The stock price is in the mid 40s, so they're down on their investment. The total cost, the 500,000 shares times 66, is roughly $33 million. They bought back another 17 million of common stock. I searched this report and there's not much more info on what the 16.8 million represents. So in their financing section, they had a cash outflow of 51 million. Let's look at the stock on Simply Wall Street. Its last price, 46, 2.8 billion market cap, down 5.5% in the past week. Down a massive 84% in the past year. They IPO'd in 2015 at 22. It fell to its lowest point in 2017 at $12. And then there was a slow and steady growth the next few years. But then in 2020, it really jumped up. It peaked at 370. And then investors realized what a crappy company this is, and the stock came crashing down. A lot of solar companies are really struggling, and they're blaming higher interest rates because a lot of people buy solar using debt. They don't pay with cash, they take a loan, and the rates are just so high they can't justify getting solar anymore because they may save on electricity bill, but the interest they're paying on the debt is more, so they're waiting for rates to come down. Simply Wall Street values the stock at 30. They say it's 53% overvalued. 29 analysts priced this stock at 68. The revenue forecast for 2024 is 1.4 billion, then 2.3 billion, then 2.6 billion. The free cash flow forecast for 2024 is 50 million, 2025 400 million, 2026 200 million. Look how much their revenue has gone up since 2013. It was under 80 million. And then just 1 year later, it doubled to 170 million. And then a year later, it doubled from 170 to 370. And that's in 2015. Let's see how long it takes to double again. So 3 years to double again, from 370 million to 800 million. And then only 2 years to double again, from 800 million to 1.6 billion. And it went from 1.6 billion, doubling to 3.1 billion in 2 years. It peaked at 3.7 billion in 2023. It's come down, and it's probably going to continue coming down this year. They were debt-free from 2013 all the way through 2019. They started adding debt in 2020. It got up to 600 million, and it stayed at that level. But their equity is a good amount higher than their debt. This green line is their cash, which is higher than their debt, so they're in decent shape. The CEO's salary in 2017 was 340,000. Now it's over 800,000. Total compensation 7.5 million. Tenure as CEO 5 years. In the past year, there's been insider buying, no selling. 95% of the company is owned by institutions and 4% by the general public. Their biggest shareholder is BlackRock at 15%. Mainly Swedish companies have AB at the end of their company names. It stands for Aktiebolag. I don't know if I'm pronouncing that correctly, which means limited company. If you see LLC, it's an American company. And if you see the word menorah, it's an Israeli company. Their employee count went from 329 to 5,600. And the ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Wiener Börse, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support channel, you can become a member by clicking the links below. Thanks for watching.